Their biggest risks are value traps caused primarily by innovation. We think there are 35 to 40% of the S&P will be considered a value trap over time, will be X growth, will be negative growth. And we think that innovation, staying on the right side of change, is going to be ever more important during the years ahead. We believe if you give us a 5-year time horizon, that ARK is a deep value manager. The difference between linear growth and exponential growth, when your time horizon moves from 1.5 years to 5 years, is night and day. And that's the arbitrage we are playing.
Hi, welcome to the video, and today we are talking about value traps. It's a stock or investment that appears to be a very, very good opportunity, but in reality, it's a trap because it's only cheap because it has no future. In this video, I'm going to explain exactly what a value trap is, some examples of value traps, and one of my biggest personal investing mistakes, not understanding my investment and not thinking far enough into the future. And this is really important because I believe we are on the cusp of a very, very big change. So a lot of the companies that seem like really good deals right now are not actually that great of deals, and we should focus on some stocks that may appear to be volatile that will get your heart and stomach turning, but those are actually the best opportunities, and they represent deep value opportunities, meaning if you look at it from a much longer time scale, what is scary now is actually the best value in the long term. But let's dive right in. This is from Investopedia. What is a value trap? A value trap is a stock or other investment that appears to be cheaply priced because it has been trading at low valuation metrics, such as multiples in terms of price to earnings, price to cash flow, or price to book value for an extended time period. A value trap can attract investors who are looking for a bargain because they seem inexpensive relative to historical valuation multiples of the stock or relative to those of the industry peers of the prevailing market multiple. The danger of a value trap presents itself when the stock continues to languish or drop further after an investor buys the company. So, key takeaways. Value traps are investments that are trading at such low levels and present as buying opportunities for investors, but are actually misleading. For a value trap investment, the low price is often accompanied by extended periods of low multiples as well. Finally, a value trap is a poor investment because the reason for the low price and low multiples is the company is experiencing financial instability and has little growth potential. So let's take a look at a past company that turned out to be a value trap. I don't know if everybody knows it because we are getting a younger investing crowd, but this is Sears. Sears, you might remember from malls, but it was actually the parent company of a chain of retail stores. They sold household goods, hardware, clothing, furniture, basically everything you need. And they actually came out with the very, very popular Sears catalog where you could actually order stuff from a catalog. You didn't even have to go into a store. You could say like a type of Amazon before Amazon was a thing. It was the one-stop shop for a lot of Americans' needs. And at the time, it would seem silly that Sears would ever go bankrupt. Disruption and value traps are always easy to see in hindsight. Actually, you can see them 100% of the time. The hard thing is to make predictions about where we are going rather than where we were. So here we can look at its stock, and you can see that in 2007 it peaked roughly at $131 per share. At 2007, not many people were saying that malls and retail stores were going out of business. So you could see that it dropped over 25% all the way down to $90, but it used to be at $130. So that means if I bought it at $93 and it goes back up to $130 eventually, that could be an easy 25-30% gain. Now you could have bought it, it comes up a little bit, but then it continues to drop. And now at $75, wow, it's almost at half the price it was. It keeps dropping at $56, less than half the price. And this is the perfect example of a value trap. Because you think of Sears, Sears was a household name. Everybody knew about Sears. Everybody has bought something from Sears. At $50, this really seems like a great deal. But obviously, if you were projecting into the future and thinking about where the future was. And in hindsight, it's in online stores like Amazon. But had you been buying all the way down, ultimately you would have lost a lot of money because it never ever recovered to 130. And that's the danger of a value trap. Now, looking at this graph, I know some people might say, well, if you had bought it at $34 and then sold it at $75, you could have still made money. And 100% that's true. If you are this hypothetical investor that could buy at the exact low and sell at the exact high, why are you even on YouTube? You would be the most successful investor in the world. In reality, even the best day traders will admit that a successful trade will often be buying 30 or 40% before it hits the low and selling 30 or 40% before it hits the high. So realistically, a lot of people that are successful would have bought at maybe 50 and then sold it at maybe 70. So maybe a 30% gain. For a majority of us, statistically, buy and hold always wins out because we are not hedge fund managers. We do not have the time to become the 0.01% of traders that are actually successful in day trading. So you could play this game and win these little micro trades, but ultimately wealth is built through long-term holds. And if you were investing in Sears long-term, you would have lost almost all of your money. So what are some current potential value traps? And I have to say potential because I can't predict the future. And don't be too attached to these companies that I'm talking about. I just want to give you some ideas of why they could be value traps. You have to think for yourself and have your own theory about where the future is going. So let's look at a company like GM. Even though you can see that it's gone all the way up, the trend is still upward. This could also be a value trap. Because remember, and this is very important, when we are talking about investing, when we're talking about value traps, we're not talking about can you make money in 6 months? Can you make money in 1 or 2 years? That is too short of a time frame. A lot of the comments, a lot of the people and new investors on YouTube, because they haven't been investing for, let's say, 10 years yet, they don't understand exactly how the market works, or emotionally, it's hard for them to process what's happening. I think GM still has room to grow up in the short term. But in the long term, if you really pull it out, let's say all the way up to 2030, I think GM could be a value trap because in the long term, it's highly likely that GM could go bankrupt. Even though they talk a lot of great game, they started off too late and they do not have a competitive advantage right now. They also are continuing out of necessity to sell a lot of internal combustion engine cars. And I think they will just have a hard time competing with the Teslas, even the Neos, just these new, younger, leaner companies that are built for the EV future. So even a company like GM that looks very good, if you bought it here, like I said, you would have made money. But at this point, I don't consider you an investor. You are just a swing or day trader, and that's totally fine. But for a long-term hold, this could be a value trap. And the final example I'm going to give is something I fell for. This is an MLP called ET, or Master Limited Partnership. It's not technically a stock, but if you were to buy it, it behaves like a stock. Let's just say it's a company you can invest in and buy shares in. So ET in early 2020 to mid 2020, their dividend yield went as high as 19%. So a 19% dividend yield is absurd. That's essentially matching the performance of Berkshire Hathaway, but in actual cash. So I invested a pretty large sum of my portfolio into this to hedge against EV, but also because that was such an amazing dividend yield. If you just had $100,000 invested in this at 19%, you would be getting $19,000 a year. That's enough to actually just live in some countries. But this turned out to be a value trap because a couple months later, they cut their dividend. So I was only able to get 1/4 of dividend at that rate. And then once they cut it in half, it was at 8%. And we have to think of the much larger issue. ET is an energy company with oil holdings. So think about if you were to invest in ET, even in its lowest, and remember, investing in its lowest would require perfect performance and no traders are able to catch the perfect dips. You have to think about long-term, what is the future of oil? But as a long-term 5, 10, 20-year investment, this is likely going to be a value trap. It's not going to ever reach its previous highs of $35 per share. That's just incredibly unlikely. And that's because, or my idea on where the future is that the future is electricity. So based on that assumption, I can predict that this will probably not be the best place to invest your money. And there's a lot of things that could be value traps. So I think some cruise lines, some airlines are also potentially value traps. And even though something like United, so when it crashed this much, me and a lot of other people would assume that it has to come back a little bit. I would agree. I put some money here, bought here, and I sold it on its way up just to make a quick 20-30%. That's totally okay. When you're doing plays like this, there's always an opportunity cost, and that's what you have to remember as well. However much money I put into here and it did this, it required attention, it required capital. And if you're watching this, if you have a normal job, if you have a family, to do these types of plays, it's hard to do it all the time, and it's hard to do it successfully. A lot of times you might actually lose money because there's a lot of space for you to buy it on the dip when it seemed like it was good value, but then it continued to fall. So I want to repeat that most people that get very, very wealthy investing don't do it by day trading. They actually do it by finding the stocks that they have high conviction in that grow a lot. You can either do this, you can make money from day trading, or you can find the next Spotify, the next Tesla, and 50 or 100x your investment. And all you would have to do, it's a front-loaded process where you do a lot of research up front, you have an idea, and you invest a substantial amount of money into a company that you truly, truly believe in, and then you just hold forever. You just hold through the ups, you hold through the downs, you hold until it multiplies in value, and then eventually you can start considering maybe drawing out of it, and it would only be long-term capital gains versus these swing or day trades where you have to pay a lot more taxes. So just consider that. You could hold 100 companies, you could be day trading every day and making $100 here, losing $100 here, making $1,000 here, losing $1,000 here, or just find the one or two companies that has that 10, 100x exponential growth. You will beat out the 99% of other investors because they're playing in so many stocks. They don't really understand any one company enough to know whether they need to be buying or holding, or if it's a value trap or if it's a growth stock. Just focus your energies on a couple of stocks, have a couple of ideas, and really see those ideas through. Investing in the S&P 500 will always be miles and miles better than just holding your money in cash. But looking at what constitutes the S&P 500, I think there are a lot of companies that are potentially value traps, and you just need to be aware and think about what your goals are, whether or not you want to grow at 5 or 10% a year, whether you can take a big reckoning where, let's say, 20-30% of the S&P 500 suddenly drops a lot or goes out of business. Were there other opportunities that could have grown your money faster and actually with less risk? Things that seem risky now, are they really risky if that's the direction that the world is ultimately going? And that's the last thought I'll leave you with. Please like and subscribe if this was helpful at all. It helps me out tremendously. This is Green Knight Trading, where Squires become Knights. Thank you all so much for watching. I appreciate you, and I'll see you soon.
We embrace our value colleagues, and especially those who are alerting their clients that there is serious risk out there of disruptive innovation.